Welcome to our reading on financial analysis techniques. Now, this is a very important reading for the CFA exam because we're going to see all of our ratios here. Now, remember, the whole point of our financial reporting and analysis is not to turn you into an accountant. You're an analyst, so you're comparing companies' performance, you're looking at companies' performance over time, and of course, we're going to use ratios to do that. So why do we have all of those accounting principles, all of those estimates and judgments that you're being tested on? Because the point is, you need to know how the accounting principles, you need to know how the estimates and judgments that the company uses in its accounts affect the ratios that you calculate. In other words, how they affect the ratios we calculate, how that therefore affects how we view the company's performance over time, and of course, if we're comparing between companies, how that essentially reduces the comparability between the ratios that we calculate. Okay, so we have interpreting ratios. You typically don't look at a ratio in isolation. You need to benchmark it against something to see how it's changed. Now that gives us two sources of doing this. We can either do cross-sectional analysis. So here is where we look at a single company and we look essentially at how its ratio compares maybe to other companies within that sector, maybe industry averages. So cross-sectional, we're looking at a fixed point in time and comparing our company to industry averages, competitors, etc. Now, the alternative to that is time series analysis. With a bit of time series analysis, what we're going to be doing is looking at our single company, but looking how its ratios change over time. Okay, so we're looking for trends in the ratios over a period of time. Now, it's very key when we look at ratios that we understand ratios actually identify the questions that we should be asking the company's management. They don't necessarily answer those questions in their own right. So our learning outcomes statement here asks us to describe the tools and techniques for financial statement analysis. In particular, it talks about the uses of ratios and the limitations of ratios. Now, vertical common size statements, we've seen these already when we were looking at our income statement and the balance sheet. Remember, the problem with the accounts is everything is in monetary terms. As a result, it makes it pretty difficult to compare companies of different sizes or essentially when companies are changing in size over time. So we want to convert our accounting amounts into essentially relative amounts. And we do that by producing common size statements. Now remember, in the income statement, we simply show each balance in the income statement as a percentage of sales. Typically in the balance sheet, we show each balance sheet account as a percentage of total assets. So we've got a couple examples there. We might be looking at our marketing expense as a percentage of sales. We might be looking at our cost of goods sold as a percentage of sales. Obviously, sales as a percentage of sales will be 100%. In our balance sheet, again, our little example here, maybe we look at our ending inventory as a percentage of total assets. Now that's a vertical common size statement, but you might as well find horizontal common size statements. So notice we've got cash, inventory, long-term debt, and net plant, property, and equipment here. Now remember, property, plant, and equipment, when you see the phrase net, it means the gross cost, the historic cost, minus accumulated depreciation. Now notice year 0, everything is given a value of 1. So this is our base year. What we're then looking at in year one is essentially how the balances have changed. Let's take our inventory, for example. You can see it was 1 in year 0, it's now 1.1. So that is clearly a 10% increase in inventory between years 0 and year 2. Now if we, year 0 and year 1, I should say. If we look at year 1 and year 2, you can see it goes from 1.1 to 1.4. How do we interpret that 1.4? Well, we're saying inventory in year 2 is 40% greater than it was in year 0. If we want to look at the change between year 2 and year 1, of course, what we would need to do is look at 1.4 divided by 1.1. Okay, minus 1. Look at the percentage change, in other words. Let's quickly do that on my calculator. 1.4 divided by 1.1, subtract the 1, and we're saying, actually, between year 1 and year 2, our inventory changed by 27.3%. Okay, so the key point with a horizontal common size statement is we can actually look at how the balances change over time. So it's particularly useful for trend analysis. We're asked to be able to describe graphs. Again, graphs allow us to compare performance over time. Maybe we're looking at the performance, so it's based on income statement items. Maybe we're looking at financial structure, so it would be more balance sheet focused. Now again, often we're going to use graphs to present information, communicate the analyst's conclusion in a visual way, okay, rather than just having stacks of numbers in our reports. So it's nice and visual. You need to be aware of the types. A pie graph, of course, so maybe with a pie graph you're looking at a circle, of course, and maybe we're looking at the composition of the balance sheet, so we can see, okay, our equity is this amount, our, let's say our liabilities is this amount, and our assets are this amount, that kind of thing. So you can get the relative proportions of essentially the assets in the balance sheet. So a pie graph, everything's shown as a percentage of the circle. Stacked column graph does essentially the same thing, but we're going to look at composition of total value over time. And a line graph is going to be able to, it's more easy to see changes over time. So let's have a look at a stacked column graph. Okay, so you can see what we're looking at here. Cash, our trade payables, lease obligations, and long-term notes. So we can actually see, therefore, how the balances are changing over time and compare them. So you can see very clearly in X4 and X5, there were no lease obligations, but we can see in X6, they're entering into lease obligations as our green little area there starts to increase. And you can see that that is actually increasing over time. So immediately we can see, okay, the company started to enter into leases, and that seems to have increased between 20x6 and 20x8. We can also look at our trade payables, and we can see broadly just by looking at the diagram, oh yeah, they're increasing over time, our trade payables. But when we look at our long-term notes, the purple areas here look like they were slightly increasing between 20x4 and 20x5, a bit more of an increase into 20x6, more of an increase in 20x7, and then suddenly we can see a decrease in 20x8. So very nice to see performance over time. Okay, here's our line graph. All we're doing then is actually drawing lines between the points. So now actually you can see, hey, look at those lease obligations. They were 0 in X4 and X5. We can then start to see the increase over time from X6 to X7. So you can see trends very nicely. Let's look at those long-term notes that we were looking at. And there you go, you can see them here easily increasing between X4 and X7, and then suddenly a decrease in X8. Okay, so that's a line graph. Now, very possible we might be asked about the limitations of financial ratios. Now, the first one we've got there is they are not particularly useful in isolation. What we need is some form of benchmark to compare our ratio to. And as we said, we can do that cross-sectionally by maybe comparing to industry averages and competitors, or of course, maybe we can do it over time by looking at how our company's ratio have changed over time. Okay, so in other words, if you just purely look at a ratio number, it tells you very little. We need to see how this ratio stacks up, maybe with competitors or maybe over time. Now, of course, the problem is if we are comparing the ratios between two different companies, then the financial statements are going to be distorted, if you like, or the financial statements are going to be distorted, and the ratios we're going to calculate are going to be distorted if the two companies have chosen different accounting policies. Okay, so the accounting principles and policies, the estimates, the judgments we use in the accounts, that affects the financial statements, that therefore affects the ratios. So two different companies choosing two different accounting principles, you're going to get distortions when you try and compare their ratios. Let's imagine two different companies. One essentially is looking at a long-term contract and it uses percentage of completion. The second firm doesn't meet the criteria for percentage of completion and has to use completed contract. Well, that's going to change the financial statements and therefore reduce the comparability when we calculate the ratios between the two firms. Finding comparable industry ratios for companies that operate in multiple industries. Now, when we look at the income statement and when we look at the balance sheet for a conglomerate, so a company with many different divisions in many different industries, when we look at their income statement and balance sheet, we're seeing the consolidated results. In other words, we're seeing the results of all of their divisions added together. Now, the problem therefore becomes, if we want to do cross-sectional analysis, how do we find a benchmark? How do we find similar companies? Because what you would need to find is a similar company that has the same operating activities, similar divisions, and not only that, but you'd need to find a company that has the same operating activities in the same proportions as the company we're going to compare against. So in other words, for conglomerates, because we're looking at consolidated income statements and balance sheets, it's very difficult to find cross-sectional benchmarks. Now, there is a bit of solution to that, because if you are a conglomerate, if you are an organization that has many different divisions with many different operating activities, then in your footnote disclosure, you will need to give some segmental analysis. So in other words, what you do in your footnote disclosure is you have to give limited financial data on each of the divisions, each division's sales, each division's operating profits. We're going to see segmental reporting in just a little while. All ratios must be viewed relative to one another. In other words, if one ratio changes, what does that tell us about another ratio? Okay, so we don't just simply view them in isolation, we need to look at the big picture. And then finally, of course, we might want to determine a target. In other words, a range of acceptable values for our ratios. And that, of course, brings in judgment. Okay, common size income statement. We've touched on this so many times now. We know simply with a common size income statement, we're going to show every item in our income statement as a percentage of sales. And of course, that allows us, therefore, to compare how items in the income statement have changed over time. So it allows us to analyze changes in our cost structure. How is cost of goods sold changing as a percentage of sales over time? How is sales, general and admin changing? How's our tax expense changing? Our interest expense changing as a percentage of sales over time? So very good, of course, for trend analysis, but also we can use it cross-sectionally. Remember, problem with comparing absolute monetary values in the balance sheets between two companies is the two companies could be very different sizes. Well, of course, the beauty of a common size income statement is it's a relative measure. Rather than looking at absolute monetary values, we're looking at percentages. So much more useful comparing companies of different sizes. Okay, so here we have a little common size income statement. And we've got 2 years. Again, whenever you've got data, just check the order of those 2 years. So we've been given the older year first, the most recent year second, and we've been given some industry average. So we can actually do some cross-sectional by comparing to the industry average, but we could also do some trend analysis here by comparing to the prior year. So we can see simply by looking at this, cost of goods sold was 58% of sales, but it's increased to 62% of sales. Now hang on, if our cost of goods sold is increasing as a percentage of sales, it means of course our gross profit must be decreasing as a percentage of sales. So our gross profit margin must be falling for this company. So notice essentially cost of goods sold was initially below the industry average, so we seem to have an advantage compared to the industry, but of course by 20x8 we have a balance that's above the industry average. Sales, general and admin, we can see in 20x7 was 18%, the same as the industry, but by 20x8 it had grown to 22%. So we're now above industry averages. So we might want to ask our company's management, well, why? Why have we suddenly got sales, general and admin that is bigger than the industry average? Why is this increasing as a percentage of sales? Does it mean we're not controlling our costs properly? And we've of course got net income as a percentage of sales, which is the net profit margin, net income divided by sales. And you can see that our net profit margins appear to be lower than the industry average, the industry making a 10% net profit margin. We were 9% last year, and it appears to be getting worse for our company. Okay, so we can see we've got an increase in cost of goods sold for our company over time. That either suggests a lower selling price, maybe the sales figure has fallen. Because if you think about it, if cost of goods sold as a percentage of sales changes, that either means sales are getting smaller or cost of goods sold as a monetary value are getting bigger. So it either means a lower selling price or lower selling volumes, or alternatively, higher cost of goods sold, so higher cost of material, labor, etc. When we look at our sales, general and admin, we can see that that increased over time as well. Again, this suggests either a lower selling price, and hence our revenues have declined, or increasing costs in this area. And of course, a lower profit margin, well, that lower profit margin, again, could be a lower selling price or higher expenses. And we've already seen in our example, both cost of goods sold and sales, general and admin, two large expenses in our income statement increased. So no surprise, the net profit margin fell for this company.